Decoding Inflation, your guide to protecting your wealth. Ever feel like your money isn't stretching as far as it used to? You're not alone. Inflation is a silent wealth thief, but don't worry. We're here to arm you with the knowledge to fight back. Inflation, at its core, is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Imagine your favorite coffee costing $3 today, but next year, it's $3.30. That's inflation in action. Understanding inflation is crucial for everyone, especially new investors, budgeters, and savers. It directly impacts your ability to afford everyday necessities, achieve your financial goals, and grow your wealth over time. Ignoring inflation is like navigating a ship without a compass. You'll likely drift off course. Inflation doesn't just appear out of thin air. It's driven by a complex interplay of economic forces. Two primary culprits are demand-pull inflation and cost-push inflation. Demand-pull inflation occurs when there is more money chasing fewer goods and services. Think of it like a popular concert where ticket demand far exceeds the available seats, driving up prices. This can happen when the economy is booming and people have more disposable income to spend. Cost-push inflation, on the other hand, arises when the costs of production increase. For example, if oil prices surge, it becomes more expensive to transport goods, manufacture products, and even grow food, leading to higher prices for consumers. Supply chain disruptions like those experienced during the pandemic can also trigger cost-push inflation. Another factor is expansionary monetary policy. When central banks lower interest rates or increase the money supply, it can stimulate borrowing and spending, potentially leading to higher inflation if not managed carefully. Central banks, like the Federal Reserve in the United States, play a critical role in managing inflation. They use various tools to keep inflation within a target range, typically around 2%. One of their primary tools is adjusting interest rates. Raising interest rates makes borrowing more expensive, which can cool down the economy and reduce demand-pull inflation. Conversely, lowering interest rates can stimulate economic activity during periods of low inflation or recession. Central banks also use open market operations, which involve buying or selling government securities to influence the money supply. Selling securities reduces the money supply, while buying securities increases it. Managing inflation is a delicate balancing act. Central banks must carefully consider the potential impact of their actions on economic growth and employment. Overly aggressive measures to curb inflation can trigger a recession, while inaction can lead to runaway inflation. Inflation directly impacts your purchasing power, which is the amount of goods and services you can buy with a given amount of money. As prices rise, your purchasing power decreases. Imagine you have $100. If inflation is 5%, your $100 will only buy you $95 worth of goods and services next year. This erosion of purchasing power can significantly impact your ability to save for retirement, afford a down payment on a house, or even cover everyday expenses. For budgeters, inflation means constantly adjusting your spending habits to keep up with rising prices. You might need to cut back on discretionary spending, find cheaper alternatives, or negotiate better deals. For savers, inflation can eat away at the real value of your savings. If your savings account earns 1% interest, but inflation is 3%, you're actually losing 2% of your purchasing power each year. While inflation can be detrimental to savings held in cash, it can also create opportunities for investors. Certain asset classes tend to perform well during inflationary periods. Stocks. Historically, stocks have provided a hedge against inflation over the long term. Companies can often pass on rising costs to consumers, protecting their profits and stock prices. However, it's important to choose companies with strong pricing power and solid fundamentals. Real estate. Real estate is another asset class that can benefit from inflation. As prices rise, so does the value of real estate. Additionally, landlords can increase rents to keep pace with inflation, providing a steady stream of income. Commodities. Commodities, such as gold, oil, and agricultural products, tend to rise in price during inflationary periods. This is because they are often used as raw materials in the production of goods and services. Inflation-indexed securities. These are bonds whose principal is adjusted to compensate for inflation. Treasury. Inflation-protected securities, TIPS, are a popular example. They offer a guaranteed real return, regardless of inflation. Diversification is key. The most important strategy for investing in an inflationary environment is diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes to reduce risk and maximize potential returns. Protecting your savings from inflation requires a proactive approach. Simply leaving your money in a low-interest savings account is not enough. High-yield savings accounts. Consider moving your savings to a high-yield savings account or a money market account. These accounts typically offer higher interest rates than traditional savings accounts, helping you to keep pace with inflation. Certificates of deposit, CDs. CDs offer a fixed interest rate for a specific period of time. They can be a good option if you're looking for a safe and predictable way to grow your savings. However, be sure to compare rates and terms before investing. Inflation-adjusted bonds. As mentioned earlier, TIPS are a great way to protect your savings from inflation. They offer a guaranteed real return, regardless of inflation. Consider investing. While investing involves risk, it also offers the potential for higher returns than traditional savings accounts. Consider investing a portion of your savings in stocks, real estate, or commodities to outpace inflation. Reevaluate your budget. Regularly review your budget and make adjustments as needed to keep up with rising prices. Look for ways to cut expenses, negotiate better deals, and increase your income. Inflation can wreak havoc on your budget if you're not prepared. Here are some strategies to help you master your finances in an inflationary environment. Track your spending. The first step is to track your spending to see where your money is going. Use a budgeting app, spreadsheet, or notebook to record your expenses. Identify areas to cut back. Once you know where your money is going, look for areas where you can cut back. Can you reduce your spending on entertainment, dining out, or transportation? Negotiate bills. Don't be afraid to negotiate your bills. Call your cable company, internet provider, and insurance company to see if you can get a lower rate. Shop around for better deals. Compare prices at different stores and online retailers to find the best deals. Use coupons, promo codes, and cashback apps to save even more money. Meal plan and cook at home. Eating out can be expensive. Plan your meals in advance and cook at home more often to save money on food. Consider generic brands. Generic brands are often just as good as name brand products, but they cost less. Automate your savings. Set up automatic transfers from your checking account to your savings account each month. This will help you to save money without even thinking about it. Let's look at some real-world examples of how inflation can impact your finances. Scenario 1. The rising cost of groceries. Imagine you typically spend $100 per week on groceries. If inflation is 5%, you'll need to spend $105 per week next year to buy the same amount of food. Scenario 2. The shrinking value of savings. Suppose you have $10,000 in a savings account earning 1% interest. If inflation is 3%, your real return is 2%. This means your purchasing power is actually decreasing. Scenario 3. The impact on retirement. If you're planning to retire in 20 years, inflation can significantly impact the amount of money you'll need to save. You'll need to factor in the rising cost of living when calculating your retirement needs. Scenario 4. The opportunity in real estate. If you own a rental property, you can increase rents to keep pace with inflation. This can help you to maintain your income and protect your investment. Building inflation-resistant wealth requires a long-term perspective and a disciplined approach. Invest in growth assets. Over the long term, growth assets like stocks and real estate have historically outperformed inflation. Rebalance your portfolio. Regularly. Rebalance your portfolio periodically to maintain your desired asset allocation. This will help you to stay on track with your financial goals. Stay informed. Stay informed about economic trends and inflation forecasts. This will help you to make informed investment decisions. Seek professional advice. Consider seeking advice from a financial advisor. A financial advisor can help you to develop a personalized investment strategy that takes into account your individual circumstances and risk tolerance. Focus on value. When investing, focus on value. Look for companies and assets that are undervalued by the market. Be patient. Building wealth takes time. Don't get discouraged by short-term market fluctuations. Stay focused on your long-term goals. There are many myths surrounding inflation. Let's debunk some of the most common ones. Myth 1. Inflation is always bad. While high inflation can be detrimental, moderate inflation is often seen as a sign of a healthy economy. Myth 2. The government can control inflation perfectly. Central banks can influence inflation, but they can't control it perfectly. Inflation is influenced by a complex interplay of economic factors. Myth 3. Cash is king. During inflation, holding cash during inflation is a losing strategy. Inflation erodes the value of cash over time. Myth 4. Investing is too risky. During inflation, while investing involves risk, it also offers the potential to outpace inflation. Myth 5. You can time the market. Trying to time the market is a fool's errand. It's better to focus on long-term investing and diversification. Want to dive deeper into the world of inflation and personal finance? Here are some valuable resources. Websites: Investopedia, The Balance, NerdWallet, and the Federal Reserve's website. Books: The Total Money Makeover by Dave Ramsey, The Intelligent Investor by Benjamin Graham, and Rich Dad Poor Dad by Robert Kiyosaki. Financial advisors: Consider consulting with a certified financial planner, CFP, for personalized advice. Inflation is a reality we all must face, but it doesn't have to be a financial burden. By understanding its causes, effects, and strategies for protection, you can take control of your financial future and build lasting wealth. Remember, knowledge is power, and with the right tools and strategies, you can beat the inflation monster and achieve your financial goals. Ready to take the next step? Subscribe to our channel for more financial literacy tips and investment guides. And share this video with your friends and family to help them protect their wealth from inflation. Don't wait, start securing your financial future now.